market news now, U.S. futures are down, with all eyes on minutes from the Federal Reserve's June meeting for clues about the central bank's monetary policy path. In the meantime, while China and U.S. tensions and weak economic data from Beijing have dampened the mood, in other news, we are seeing that the second half of the week has also some sets of economic data that is expected, including the non-farm payrolls report on Friday. Investors will focus on the minutes from the Fed's most recent policy meeting, which is expected at 8 p.m. South African time. To give us more perspective on the markets, we are joined by Jones Gondo, who's a senior research analyst at Nedbank CIB. Jones, thank you so much for your time. Your take on market sentiment right now and what's driving markets both locally and abroad?
I think it's all about the rate path that you mentioned in the introduction. We've seen significant US bond curve inversion, and that has just reignited new fears about whether a recession or hard landing will enter into the global economy again. And we'll see what the minutes say, but it could mean that we still could have rate hikes for a little while longer than the market had expected. And domestically, I think it's the same story, where the Reserve Bank governor at least gave a view that the trend in inflation is starting to ease and that the rate hikes are starting to work. But there's still some work to be done on putting a solid cap on inflation expectations.
Let's look back at the first half of the year. What stood out for you? And I suppose, what does that mean for the second half in terms of your expectations?
No, I think, to be fair, I think the pace at which, again, policy rate hikes in the first half was a lot more than people expected. We expected to have reached peak inflation at the beginning of the year if we're going to look back at what our calls were. And subsequent to that, we're going again into a cycle where we're expecting this time inflation to peak. And we should start to get more stable or fewer rate height increases into the second half of the year and start looking at cuts into early next year. And so I think the big difference here is just an adjustment to significantly higher interest rates and the impact of those higher rates on consumption demand, on investor sentiment. But I must say that one of the sort of more positive things to look out for is the investments that are being made in energy embedded generation in South Africa. That's definitely something very different in our environment compared to the first half, where we were looking at stage 6 load shedding. So that outlook will be very meaningful for the second half.
So, one thing I'm curious about here is your view on China, because as much as in the first half we were talking about interest rates and inflation, the other piece of information or piece of news we're going into for the second half is the state of China's economy. What are we understanding here, especially when we are seeing the data come through?
Look, I think there was we looked at the PMI data, which came out softer than the market expected. And it's generally pointing to a secular slowdown in China. And it's not being matched by the kind of stimulus I think the world is looking for out of China to reignite that economy. It's been a very slow and tepid reopening from their COVID lockdowns. And that is having an impact on markets and view on demand for South Africa and the rest of the continent that are commodity rich. That means demand for the core commodities looks a lot weaker going forward.
How are you classifying the U.S. tech sector right now? Is it a defensive play, given that we're leaning towards this AI frenzy?
You could picture it that way. If by defensive, we really mean that it's uncorrelated to a lot of the macroeconomic risks we were talking about. I think the whole move towards AI just shows a new moat or area of growth that just isn't available in the real economy at the moment. When I mean real economy, I'm talking about traditional sectors. And in that sense, there's been a big rally of names like Nvidia in the US that specialize in components and equipment that is related to AI technologies. And I think, in a sense, we also have to take into context that there will be changes in regulation that are coming along the way, especially in the US around this. And so that could weigh on the outlook for that. But for now, it's definitely acting in a very defensive manner.
Jones, thank you so much for your time. That is Jones Gonda, who's a senior research analyst at Nedbank CIB.